Some of the research shows that the baby boomer generation doesn't think about an exit. Like, exit's not in their vocabulary until it has to be. But that millennial, say generation is really thinking about it a lot earlier in their career, which I think is great, because you're absolutely right. If you could start the business earlier in its life, thinking about building it for an optimal exit, that does a lot of things for the owner.
I do think that generation, when they started a business, they didn't think about it from a exit standpoint. They were, in a lot of ways, maybe starting themselves just a job, a lifestyle business, and then hopefully, grew into something. Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Joe LoPresti. He's the founder and CEO of ClearPoint Family Office and Arlington Wealth Management. He's bringing 4 decades of experience in wealth advisory. I'm actually going to stop there, Joe, because like I said, I want to let you kind of unpack all of this for us. There's a lot here, and I'm excited to talk about it. So first, let me say thank you. Thanks for coming on the show today. Thanks for taking the time. I am very excited for the conversation.
Yeah. Thanks for having me. I'm excited as well. So it's ClearPoint Family Office is the family office entity that we run, and so just a little bit of background on myself. So I have a lot of background in wealth management, 40 years. I started off, working for some of the big brokerage firms and banking firms, and really quickly found that, that culture, that sales culture, wasn't really it didn't resonate well with me. So sure. I branched off on my own relatively early in my career, developed investment models and proprietary indicators that we use today in our investment management. And then we, as our clients got wealthier, we realized that they needed more than just investment advice and wanted advanced planning centered around tax strategy, business advice, wealth transfer, and so forth. So we added more advanced planning and comprehensive wealth management services. And after we did that, we realized that our business owner clients really had that added layer of complexity, and there was a void missing, we found, in the advice that business owners were getting. So we decided to really focus on helping business owners, and ClearPoint Family Office does that, in coordinating their business strategy with their personal wealth planning, and putting it into an integrated approach to help them, achieve their essential life goals and secure their freedom.
Okay, great. That's excellent. I think I saw something in here about 3 decades of winemaking as well, or third generation winemaking. So we'll have to see how that plays into the story. But
okay.
I think so. One of the topics, or one of the, I guess, things you mentioned just now is that the void in sort of planning for business owners. Can you maybe go in a little more detail, dive in on the void that you kind of perceived, and then we'll talk too about what you do to alleviate that or help fill in that space.
Yeah. So the void from what they get from their advisors is, the way I see it, is they're working with individual advisors, accountants, financial advisors, attorneys, maybe some business advisors, et cetera, insurance, but they're getting siloed advice, right? So they're getting the advice from the accountant about taxes and accounting, and the financial advisor, et cetera, but it's up to them then to put that into some sort of coordinated approach that's going to optimize what they're building. And there's no collaboration amongst their advisors. So, I talk to many of my clients' accountants, but we don't really collaborate, right? This is going back, say, 7 or 10 years ago, until we realized that void was there, and the best thing we could do is build a team that sits around a table and talks about the client and their agenda, and how do we build synergistic strategies that cross over the financial and tax and legal lines, and really create wealth building opportunities for those clients, and importantly, eliminate the gaps that occur from that siloed advice.
Yeah, that's. I mean, I'm quite certain I don't necessarily probably fall into the category of many of your clients, but I think the problem is a very real one. You start to get into the space of being a business owner, whether that's one or maybe you have multiple or you have investment, like all of the advice coming at you from sort of different angles, and you'll have the attorney that wants to set up an entity. As an example, the attorney wants to set up an entity in this particular structure, and for X, Y, and Z reasons, and then the accountant is like, yeah, but that's not your best tax strategy, and all. And so I think it is something that I have seen just kind of in our own businesses where that is a struggle that I face, and the idea of having it be, I guess I hadn't thought about doing it the way that you're describing. I said to one of my friends the other day, I just said, I hope to someday be have enough of a business to have my own bookkeeper, accountant, and attorney, like just that part of the team that is taking care of just my stuff. Because I think the other piece is when you outsource that, which I think most people do, you're not their only client. And so like, oh, I have this question or I need this thing done. And it's like, okay, you get kind of put in the queue and then it comes through. So having that holistic approach of the team sitting around, and talking about what's best for that client is, I mean, I can see how that would be a very smart and kind of needed service in the world of business. Mm-hmm. Your bio mentions kind of the part about retirement, where essentially you see that many business owners regret selling their business, and I want to touch on that topic a little bit because I want to hear maybe first why do you say that, what are you experiencing, and then I want to kind of come back and tie it all together in how you approach things via this holistic view to maybe avoid that problem kind of in advance. So anyway, the first part of that question is, why do you think that, or, what do you see and why do you think that's the case?
Yeah. So, what that really stems from is a lot of surveys and research from entities like the Exit Planning Institute, where, they survey thousands of business owners and really kind of get underneath the surface of what the psychographic behind it all, right? Mm-hmm. And what they find is that, something like 85% of business owners regret, like a year later, that they sold. And it usually has to do with because they wish they would have done something different, right? And they found out about it maybe after the fact. So I kind of jokingly call that the dumb tax. Okay, business owners don't know what they don't know. Yeah. I mean, they're very good at what they do, but they can't be experts at everything, right? But we always think that we are, right? Because we built something really right. valuable, and so we think, well, we know best. So it could be a tax strategy, right? A lot of times they may be talking to somebody who also sold a business, and they told them about, hey, my advisor, showed me this one strategy where I paid X amount in taxes, and the other business owner is like, well, geez, I wish I would have known about that, right? So there's where the regret comes in, or it could be legacy, yep. How their employees maybe were treated a little bit differently than they would have wanted during the transition. They could have put things in place that they could have, design that a little bit better, right? As opposed to not thinking it through. So it's just all these different, when you go to exit a business, there are so many things that come into play that business owners, unless they've gone through the experience before, they really, they don't know what to expect. So when you think about business owners that they get to that end game, right? They get to, I like to describe it in football terms. So business owners are really good at driving the ball down the field and building incredible entities and, doing incredible things for their clients, their employees, their, the people that touch their business. When they get to about that 20-yard line, that's where all the complexity starts to creep in. And they have to think about taxes. They have to think about how to transfer wealth to, take care of their loved ones. They have to think about their employees. They have to think about how to invest the money, how to get their cash flow, after the business, all these things, insurance, asset protection, money shifting from corporate to personal assets, and how do we protect that from, liability creditors, et cetera. And that's where they just kind of hit that roadblock, and all that complexity they don't know how to get through. So working with a team of advisors that knows you, where you are, where you're going, and collaborates in all of these areas and kind of guides you through that last 20 yards, I think that's where the regret comes in, because maybe they work with an M&A advisor and he's just worried about getting a deal done. He doesn't care what kind of taxes you pay because he's getting his commission on the deal, right? Or maybe working with a financial advisor and they don't really understand the business aspect. They just want to get the money to manage afterwards. So breaking down those barriers and, working with business owners about them and where they ultimately want to go and what they ultimately want to accomplish with their life is really important, I think, to eliminate that regret.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Yeah, and I guess I would assume that the idea is to start that process, well, as early as possible, I guess, in terms of your exit planning, right? Thinking about it after it's already happened, or even, I think. Tell me what your experience is, but I think a lot of business owners essentially don't think about the exit until it's time to exit. And it's because they, just reached an age where they don't want to do it anymore, or they had, even worse, had, an illness or something. Some outside force means, hey, I'm going to have to exit this business. Oh, wait, I didn't prepare for that at all. Like, here's my, I'm just trying to get something done. So presumably evaluating that and having a plan in place in advance is going to be the smoother transition. How do you, give me your take on that. How do you think, people should look at this type of process?
So absolutely, you need to be proactive at it to maximize, and for a couple of reasons. People don't really think about it until they get to that point, and then sometimes it's too late to put certain strategies in place that you could have. Some tax strategies take a while to implement, and you have to maybe change entities and set up trusts and so forth. And so thinking that through ahead of time is definitely to your advantage. Building a company that is attractive to a buyer, you can't just do that on a whim, right? So a buyer is going to look at, if you're going to sell it as opposed to transition it to family or something like that, then they're going to look at your business differently than you likely do. yeah, they want to make money, they want it to be profitable and all those things, but there's a lot of other things they'll look at that you probably aren't. And, working on that part of your business is going to make it more valuable. So what is the right amount of time is difficult to answer. 3 to 5 years is great. The reality is a lot of people aren't that proactive, and they won't put the time in before the sale. And the other part of it is about 50% of all business owners sell unexpectedly, right? From, what
Sure.
they call the 5Ds: death, divorce, disability, disagreement amongst partners, all those sorts of things that if you put the time in to build a business and make it attractive, even if you're not ready to sell it, number one, it's more valuable always, because you might get, an unsolicited offer, and
Right.
or you might get one of those 5Ds, come into your life, and then it's more of a liquidation type of sale as opposed to something that's going to take care of your family, right?
Right. Right.
So yeah, I think being prepared, designing that exit. My book is Exit by Design, and it kind of talks about that. If you don't design it, you're going to exit by default. You're just going to take what the market gives you. So let's be proactive. Let's think about all things that evolve around an exit, educate you on that, help you make the best decisions, and help you avoid that dumb tax the best that we can.
Yeah, I think the dumb tax gets paid throughout life in many, many different ways with the things that we don't know.
Yeah.
Do you have particular industries that you tend to work with? For just in general, for anyone listening, are there types of, I guess, what's your ideal sort of client that you like to work with, so that people who are listening know, if they would fit, if it would be a good fit, and can reach out based on that?
So our ideal client is a founding business owner that built something from scratch, has a highly valuable company, almost no cost basis, right? Because it's all blood, sweat, into the equity, and they're hitting that complexity, and they want to maximize what they've built. And size-wise, it's really all over the board, but we like to say 5 to 75 million in net worth, including their business enterprise value, is the sweet spot. The family office concept dates back to the Rockefeller family, right? They were the first one back in the late 1880s, and none of our clients are Rockefellers, but the reason the Rockefellers built their own family office was they had some of the same concerns and frustrations that small to mid-sized business owners have. How do I coordinate what my accountant's telling me, what my financial advisor, and taxes creep in, and managing all this is difficult. So they brought in their own team to run it all, and that was the first single family office, and that was successful. So other wealthy people, many of the ones that we know today, Oprah Winfrey, Mark Zuckerberg, right, Tim Bezos, they all have their own family office. It's evolved over the years now to where a fractional family office, which is what we run for business owners, we bring those resources, those deep resources, in to make them accessible for the small and mid-sized business owner without the overwhelming economics behind running your own family office. Right. So we're agnostic to industry. We work with service-based companies, manufacturing-based companies, legal, across the board. And the reason is that because we have a team of 75 specialists that we could bring into any client situation that are, advanced tax planners, risk mitigation specialists, wealth advice, legal advice, business advisory. So we can bring those deep resources and help a client, pretty much eliminate their major concerns, no matter what type of business that they're in.
Yeah, I'm actually really glad. Thank you for that explanation, because I was my I guess, understanding of family office definition is typically $100 million net worth and above, but recognizing that, sort of fractional nature of your business is, that is a very valuable thing to sort of have access to, because as I mentioned, I'm nowhere near any of that, thinking about having a family office, but even with the small amount of businesses we have, and just it is hard to coordinate how it should all look together, and everybody has their different ideas. One of the big I don't know, maybe one of the hard things to recognize, and one of the reasons why having a plan like this, putting something like this, a plan in place, a team behind you early, before it's time to exit, I think probably comes a lot down to, that you've touched on the tax implications and prepping your business for sale. I don't know that it's every, but many business owners look for everything they can do to reduce the tax burden kind of at the end of each year. So it's reinvesting proceeds and buying new equipment, whatever that may be, to try and keep the tax bill down. But then that also on paper makes your business look like it's worth less, because your profit is lower, and most of these businesses are sold based on a multiple of profit. So how do you suggest people kind of reconcile that? I think that's why you have to start thinking about this early enough to have a few years where your tax bill is going to go up, but it's because you're actually realizing some of that profit. What do you have some, I don't know, tips and ways that people can
Yeah. Oh, absolutely.
get the best of both worlds? I don't know. Maybe it's not possible.
So, you're absolutely right. If you're able to do that earlier in your career to minimize profitability, that minimizes, most of these are flow through businesses, flows through the personal tax return, pass through, and you're just going to pay less taxes, right? By implementing certain strategies that intentionally reduce your business profitability. For a knowledgeable buyer, they understand that, and we can add those types of expenses back into cash flow. We call that adjusted or forecasted EBITDA, recasted EBITDA, I should say. So, like a knowledgeable buyer is going to understand that's really a benefit of the business. It's part of the earnings. We include that in the earnings, and it's going to sell for a multiple of those adjusted earnings. However, it's still optimal as you get, say, 3 years out from a sale, that you start to think about maybe putting more profitability into your company, because a buyer's going to ask for typically 3 years of financials, right, doing their due diligence. And if you could show 3 years of consistent or growing profitability, it's going to be more valuable for the buyer. Right. But there are, the tax code is so extensive. There's, over 70,000 pages of tax code. There are so many programs out there to reduce or, eliminate taxes in a number of ways, whether it's on business income, whether it's on capital gains, on an asset sale, whether it's business property, et cetera. We could work on those areas and still show your business to be highly profitable if you're approaching that sale by minimizing your personal taxes.
Right. Yeah. So, and that, thank you for the explanation. That's kind of what I was aiming for with that question. I do think it's, most people are going to want at least 3 years of financials. And so it's funny, when we look to acquire businesses, it will, you'll see I'm looking at smaller businesses, but so you'll see like SDE, the profit will be, almost nothing. And then boom, like the year that they're selling, suddenly it's dramatically higher. And again, it's, as you mentioned, like people looking to buy the business probably know why that is, right? But But if you show that over the span of more than just that 1 year leading up to sale, I think it's a lot easier for a potential buyer to believe and kind of get behind that story that, oh, we've just been, sort of reinvesting profits up until now, and suddenly everything's, so much better. But I do think that the planning on this is a huge piece. If someone is starting a business, right? So we've talked about kind of maybe we went wrong chronological order, but we talked about sort of that close to exit time. What about when they're thinking about starting a business? I would think that maybe there are certain things that you would be able to help with even at the formation phase to make that exit, however far away it may be, to be a little bit smoother. Are there things that you work with people on that end of it, or is it typically closer to exit? How do you view that?
Well, it's actually very interesting that you bring that up, because when you asked earlier about what type of time you need to properly plan this, we used to see most of our clients in that, say, upper 50s, early 60s, when they really seriously start thinking about this.
Mm-hmm.
Lately, we've been seeing a lot of business owners in their 40s thinking more about this. So some of the research shows that the baby boomer generation doesn't think about an exit. Like, exit's not in their vocabulary until it has to be.
Right.
But that millennial, say, generation is really thinking about it a lot earlier in their career, which I think is great, because you're absolutely right. If you could start the business earlier in its life, thinking about building it for an optimal exit, that does a lot of things for the owner. It gives them more personal freedom during their business career. It makes it more valuable because, say the business isn't as dependent on the owner. That's a big part of what a buyer is going to look at in terms of valuing the business. Right. Am I buying a job, or am I buying a business that can, be profitable, and I could still live a life without working 78 hours a week? So earlier the better, and begin with the end in mind is a good concept to think about for a business owner. But we are seeing that trend where younger business owners are thinking about, how do I optimize this so I could live the life that I want, as opposed to how do I just build, and when I get to retirement age, worry about selling it then.
Yeah, the generational, I guess, view of how business works and how whether or not to be that is actually a really interesting thing that you bring up, because I believe that is really true. I mean, people talk a lot about the silver tsunami, and so basically the idea, at least on social media, is that every person from the boomer generation owns a business and is about to just close their business down, and everybody can buy them up. And it's
I've been hearing about that for years now, right?
Yeah, right. It's a very popular thing to say. I have to say I have sort of even bought into that a little bit, but I think it's not quite as cut and dry as it often sounds when you see something on social media. But the fact is, I do think that generation, when they started a business, they didn't think about it from a exit standpoint. They were, in a lot of ways, maybe starting themselves just a job, a lifestyle business, and then hopefully grew into something bigger, or maybe it didn't, but it's still it gives them the good life that they have wanted, and now it's they just get to a point where it can't be a part of it anymore. It's almost like I'm Generation X, so I'm in the middle. But yeah, maybe you start to think about millennial and younger. They're almost looking at business more like private equity does, in the sense that you're looking at this 3, 5, 7, 10-year exit plan, exit strategy, rather than I'm going to have it for life. I don't know that. I don't know what the reason is behind that. I don't know what the human psychology of that is, but it is interesting thing to think about, because if that's true, then not only would we have Silver Tsunami as a factor in terms of business availability to acquire, you might then continue this wave of like periodic turnover of businesses. Who knows? I don't know what the answer to that is, or if you have any thoughts, I'd love to hear them. But it is an interesting topic to kind of speculate on.
Yeah, it's hard to say why. I mean, I think like maybe the baby boomer generation kind of started their business because they just wanted freedom. They didn't want to work for somebody else. So it's really more of a job, but it's their own, right? And they could call the shots, do things their own way. And then the ones that are successful, you know, like 20 years later, it's like, wow, I've got this really valuable enterprise that now I got to think about selling, because it's not like I'm just going to close the doors. There's just too much money to leave behind. Whereas the Gen X, millennials, they're thinking about it a little bit earlier in life, and maybe it's just natural, you know, evolution of, you know, like the baby boomers, their parents went through the Depression and all, you know, all that, and Gen X parents, you know, didn't, right? So it's probably a little bit of that going at it, but yeah, that Silver Tsunami. I mean, you've been hearing about it for years, and it's there. People are still selling their business because they're getting older, and they know eventually they have to. You know, something's going to happen, but they're holding out as long as they can. And I think part of it's because, I think a lot of it's because they can't envision how they're going to get their income after the sale of the business. So they know how they get it today. They know, you know, that they could kind of control that, but they can't envision it after the sale. So one really important thing that we do for all of our business owners is we build a lifetime cash flow plan. So we could show them, you know, how they're getting their income now, of course, maximize that cash flow of, you know, how much to leave in the business, how much to take out to diversify their wealth where it's getting too concentrated in their own business maybe, you know, plan the taxes around that, plan the taxes around the sale and mitigate those, but then also start to set up where you're going to be getting your cash flow from after the sale. And then when they see that, it's like they have this clarity and confidence that, okay, I could move forward through this transition, whereas before everything was just too unknown and I was unsure, and I'm hesitant to move forward when you're unsure.
That's a fantastic point. I mean, and I think maybe just to give listener maybe some numbers around that, even if you think, I mean, you were talking about 5 to 75 million of enterprise value, but if we look at the low end of that, right? So someone who has a business that's worth about $5 million, very likely they've got $1 million to maybe $1.5 million of profit annually in that business that would probably fall even outside whatever salary they're paying themselves. So now they sell it for $5 million, but the math in their head is, well, it only takes me, you know, 4 years to have made that much money. So I guess I work 4 more years instead of selling that. So that is, I think that looking at it that way, you know, I get it. Like that makes sense to me, that kind of math, without having some other plan of what you're going to do with that, you know, money that comes from the sale of the business. It is a tricky spot to be in. Like if you sell your business for 75 million, you're probably good. But if you sell it for 4 or 5 million and you've been making $1 million a year in profit, like that doesn't say, okay, now I've got enough to live 20 more years. Like it just, so I mean, I think that conversation that you were just discussing, you know, kind of alluding, like that's got to be a huge, you know, mental block for people as far as selling that business.
It is, and so they're making $1 million, but are you living on $1 million? So what do you need, right? What is your lifestyle? You know, let's just say it's $400,000 a year to live the life that you want. Okay, well, let's figure out what's the best way to get this up. In that lifetime cash flow planning, there's so much value in that. And one of the first things we do is determine what we call their freedom point. And that is, once we sit down with them and they describe to us the life they want, all of this is centered around the life and legacy they want to design, right? So we want to optimize things around that. And we want to determine, what do you need today? Like if you were to sell today at, some valuation, so we'll assess their business value, we'll look at the industry they operate, we'll look at the range of values that businesses have sold in that industry, do a little bit of an assessment of their business and say, if you put it on the market today, you'd probably sell somewhere in this range. So that, first of all, that gives us the ability to plan to get to the higher end by improving their business attractiveness and qualitatively. But it also helps us know, like, can I sell this today and live the life that I want? Or if not, how much do I need to grow it to get there? And what's the timeline for that?
Sure.
Right? So once you know your freedom point, it helps you make decisions from there. With business planning, we try to run down 2 tracks with every client. So we're running down a business strategy track designed to maximize enterprise value, personal wealth planning track designed to maximize their net worth. So, knowing that business value today and where it fits into your personal life, then it tells us, well, how much do we have to protect that value? If you're at your freedom point, you really want to focus on protecting that value. Let's conduct a risk assessment. Let's make sure you're mitigating risk from catastrophic decline in enterprise value, because now you're risking your freedom, not just business value that's on paper.
Yeah.
If you're not there, we need to focus on enhancing value. And let's put in, a strategic plan to exponentially increase the value of your enterprise so you can get to your freedom point. And then how do we harvest that value and put a plan in place for that as well? And on the personal wealth side, it's the lifetime cash flow plan, determining the freedom point, a tax reduction strategy, which of course also, overflows to the business,
right,
as well as the personal investments, estate planning, wealth transfer, asset protection. Those are the tracks that every business owner, I think, needs to think about if they're going to integrate it into, coordinated plan and optimize what they're building centered around the life and legacy they want to design.
Yeah, that makes so much sense. And I think it even more argues the point of being or starting these conversations and getting these things in place, as early as possible. Because ultimately, you just mentioned, like, if the answer is, oh, we have to grow this business to put myself in a position to sell it for enough that's going to, give me that freedom number. Well, growth of a business is typically painful. Takes energy. It's painful. There are levels of growth. It's like, I think what happens with a lot of business owners is, you go through that pain, you get to a point where you're good and steady and you have a good lifestyle, and then you stop growing because that's the hard part. And so if you are on the verge of being ready to retire and you, Joe, and your team are like, well, what you need to do is grow this business over the next 3 years. like that's a lot to take on if you're already in your head at the point where you're saying, I'm ready to be done, I'm ready to exit. So it's definitely something to have this plan in mind as early as you possibly can, so that it's, if you have the end in mind, what that process is going to look like to get there. And so it's, you can say, I'm starting this business. I'm 35, I'm starting this business. I want to sell it when I'm 55, but I want to sell it for, X number of dollars because I know that'll get me through retirement and leave a legacy for my family. Like, it's all math. And then it's like, okay, well, what do I need to do to get that business to that point?
And you're absolutely right, because it's all math, but taxes make a big impact on that math.
Sure. Yeah. That's part of the equation for sure.
Part of the equation. So if you could start planning for a tax efficient after business cash flow, the earlier you can do that, the better. Then somebody who needs, say, $300,000 or $400,000 a year to live the life that they want, it's a lot different if there's no taxes on that income versus somebody who has to get that income and
Yeah,
pay,
absolutely.
a higher tax rate, right? So it makes the hurdle lower in that case.
Yeah, 100%. I mean, and that's the whole the whole value of having the team. Kind of looking at it from all different perspectives. Is it's like, okay, business value, tax savings, estate planning, like all of that, ties in so intimately that it's actually hard to separate each of them out for that person, for that business owner, even though each of the professionals that might be an expert in each segment, they can separate it out because if they look at that. But when you look at it from a team perspective, now everybody's working together, kind of for a common goal for your clients. So that's I love it. I love the strategy.
Yeah, we like to ask our clients, like when they're vetting us out and thinking about working with, when's the last time all of your advisors sat around a table to talk about you, right, where you are, where your life is, where you want it to be, and your agenda versus their agenda.
Yeah.
And I usually get that kind of that blank stare coming back at. And when you think about everything we're talking about, all this complexity, assessing value, protecting value, enhancing value, harvesting value, lifetime cash flow planning, tax reduction, investment consulting, estate asset protection, it takes a lot of different professionals to coordinate that. And when you're trying to work with, an attorney, an insurance person, a financial advisor, an accountant, business advisors, all individually, it's a lot of your time to begin with. So, getting that into a coordinated team approach adds, I think, significant value to business owners during their life.
Yeah. I completely agree. I mean, most people don't sit around with their friends and have a conversation about what's going to be the best. So imagining your team of advisors all sitting in a room and doing that, I think is, I'm quite certain that most people have not experienced that. So that's a fantastic service. Yeah. Joe, let me switch gears here. We're getting towards the end of our time. I wanted to make sure I get to ask you the question I ask every guest, and that is, what is your why? The name of the show is Know Your Why. So what is your why? What's your motivation for continuing to do what you do and be successful and help people and all of that? What drives you?
Well, I think what drives me is that, I'm a founding business owner. I own 3 businesses. I own a wealth management company. I own a family office, and I own a mergers and acquisitions company. So I think I can identify with what founding business owners go through when they're trying to maximize everything that they've built and their life's work. And having that void and that gap in planning that I see so often, to me, it's motivating to just help founding business owners really achieve everything that they want in life and try to eliminate all those gaps in the planning, try to capitalize on their opportunities by collaborating with other professionals and delivering that service that I think most business owners aren't getting.
Yeah, no, that's amazing. I really, really think this is of value to people. It's a conversation that probably most people aren't having early enough, and so kind of understanding that it's important and that there are someone like yourself that can help them through that process, I think is just a great option for them. So when people hear this and they want to connect, what's the best way for them to reach out to you?
Yeah, so you can connect. ClearPointFamilyOffice.com is the company website. You could connect with me there. You could schedule, an initial phone call. There's a lot here, and this isn't right for everybody, but for the right business owner that's at the right stage of their life, it is potentially the right thing. We just have an initial discussion, no obligation, and see if there's potentially a fit to go into more of an exploratory process where we have some meetings and, learn about each other and see if there's a good fit. So that's one way. You could look me up on LinkedIn as well. Joe LoPresti, RIA, is my LinkedIn handle. And I do have a book I mentioned earlier. I'll just grab it real quick here. And Exit by Design is the name of the book. There's a website for it, exitbydesignbook.com. You can get a free copy there, an e-version or audio version there if you'd like to check that out.
Great. We will definitely get all that in the show notes so people can find you easily. Joe, thank you so much for coming on the show today. I really enjoyed the conversation, and I truly do think this is such a valuable service and really needed to help people get, be comfortable and set up right for retirement. So thank you for being here today, and thank you for sharing all that you did.
Yeah, thanks. My pleasure, Jason.
Yeah, folks listening, make sure you connect with Joe. Please like, rate, and review the show so we can continue to get more great guests. And as always, thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?